Welcome to Exiles Market. Today we are covering option basics. Now, back in the 90s and the early 2000s, if you wanted to trade options, you had to pass a test. And I mean like a written test or take a test over the phone. Brokers didn't want new investors with little or no experience buying and selling options. Today, almost anyone can trade options. And while I agree that new investors, new money in the market is good, I do. But there is a reason why it used to be more restricted. The math isn't hard, but there are a lot of moving pieces. So today we're going to cover just calls. I have a separate video that covers puts, so please go check that one out as well. I've left a link in the description below. We are looking at applied digital, and every broker is going to have a trade options button somewhere. So this is Robinhood, and the button is right here. If we click that, it's going to take us to a screen, and all of the screens that the brokers use, they're going to be laid out very similar. They're going to have the strike price right here in the middle. They're going to have a buy and a sell option up here. They're going to let you select calls or puts. There's going to be an expiration date right here that you can choose what expiration date you want. On the left here, it is going to show you the strike price. And on the right here, this is the premium or the cost of the contract. Now we are going to start with buying a call option. So that's already selected for us, so it's ready to go. Buying a call option is giving you the right, but not the obligation to purchase shares of the stock at a certain price. That price is called the strike. That's what we were talking about over here on the left. You will have up to a certain point to make this decision. That is the expiration date up here. Now, for this right, you're going to pay a fee. That's the premium. And this is the premium over here. And this is the cost to open up this option. When you buy a call, it's called a long call. Now, if you wanted to buy the $8 strike right here, and you wanted, say, 2 weeks, about 15 days to make that decision, then you're going to pay $57 right here to purchase or open this contract. I say $57 because remember, option contracts are sold in blocks of 100. So you just take this price and you times it by 100, it's 57 cents, $57 it would take to open up this contract. What you were hoping for here is that the price of the stock goes higher than whatever strike that you had. So let's say that the stock went up to, let's say $9. Your option contract gives you the right to buy 100 shares at $8. If the stock is at $9, you would exercise your position. You would buy 100 shares for $8 a piece, $800, and then you would turn around and you would sell them for $900. $9 a piece. That would make you a profit of $100 on that sale, minus the $57 that you paid to open up this contract. Now, what happens if you don't have the $800 to buy the shares? Normally, your broker will buy and sell them in one transaction for you and give you the difference. In our case, if your strike was 8 and the stock was at 9, that would be $100. Now, if the price doesn't go above $8, by the time this contract expires on the 21st, then you are out your $57. This contract expires worthless. You don't have to exercise this position. At any time, you can sell this contract. If Applied Digital went to say it went up to $10, right? Your strike is 8. The price of Applied Digital is 10. That means this contract has about $200 worth of value to it. You wouldn't have to exercise your position, buy and sell the shares. You wouldn't have to do that. You could just sell this contract to someone else. If the stock stays the same, you could still sell it on. So if your strike was 8 and when you open it up, Applied to Digital was at 788, maybe if it stayed at this price or maybe went a little bit lower, your contract is going to lose a little bit of value. But if you didn't wait until the expiration date, you could sell it on after a couple of days and maybe lose a little bit. But the point there is at any point, you can sell this contract on. It doesn't matter what it doesn't matter what the stock price is. You can always sell this contract on. If the price goes too low, your contract may not have a lot of value in it, and sometimes it is harder to sell those contracts. So keep that in mind. Selling a call is the other side of that contract. We call this a covered call. If you own 100 shares of Applied Digital, you can decide that you are willing to let your shares go for $8 on or before the 21st, 15 days from now. And instead of paying the premium, this $54, you would receive it. So right now, if you didn't own the stock in Applied Digital, let's say you didn't own any stock at all, you could buy 100 shares, pay $788 for it, and open up a covered call and receive $54. And if the stock rises to $8 or higher, your shares will be sold at this $8 price. You'd make 12 cents per share, $12, and you would keep this premium, the $54. Now, if the stock price doesn't reach this $8, it never reaches that, then you keep your shares and you keep this premium of $54. There's some additional information here. If you click this row, you're going to see some additional information down here. Most important, the Greeks: delta, gamma, theta, vega, and rho. I did a whole video explaining the Greeks, so please go check that out. Delta is how much to expect the contract to gain or lose in value if Applied Digital moves $1. In this case, it's 50 cents. Gamma tells us how much delta will change if the stock price changes. Theta tells us if the stock doesn't move, this is how much this contract is going to lose per day. So if you purchased this for 54 cents, $54, every single day up to February 21st, we can expect this contract to lose 2 cents, about 2 cents. That is assuming that the stock price stays the same. Vega is about percentages in implied volatility, and rho is about percentages of interest rates. I've covered just the basics. So if you have additional questions, leave them in the comments below, or come check out our Discord. We have 100,000 members in our Discord, and many of us are experienced traders. And we are in the chat every single day helping people level up their trading game. Thank you for watching, and I hope to see you in the next video.